Finding Alpha, The Search for Alpha When Risk and Return Break Down by Eric Falkenstein.
This is an intro to my video series that complements my book about risk, return, and alpha called Finding Alpha, available at fine bookstores everywhere. I'm an economics PhD who's worked as a quant, a risk manager, and a portfolio manager. I maintain websites here, and so you can read more to get background on where I'm coming from. Now, the big idea presented is that the data we see show risk and return generally uncorrelated. That is, when you measure risk, no matter how you measure it, you find that the high-risk assets generally have about the same return as the low-risk assets. And this is a puzzle, because theoretically we should see a positive linear relationship between risk and return. Standard theory, whatever it is, says that if you measure risk correctly, the more you take of it, the more your return should be. We cannot find that. So that's a puzzle. Also, at the low end of the risk spectrum down here, you do see a slight risk premium. So that gives people some hope. But at the really high risk spectrum here, you actually see a negative return. So for the super high lottery tickets, for the super highly volatile stocks, the highly risky bonds, you actually see a lower than average return. And that's a puzzle. And I argue that this is an equilibrium. The data are true. It's not like if we measure risk correctly, we're going to correct this and get the red line. We're always going to see this line. And I think that has implications for how you should invest. Now, what is alpha? Alpha is the first letter of the Greek alphabet, and it's the return outside of a risk-adjusted return. So in any asset pricing model, you get an expected return equals some risk-free rate plus the how much of the alpha, which is this beta, which is a covariance with some risk factor. And in the CAPM, the risk factor is a rate of return on the market minus the risk-free rate, but in other models, it's just something else, whatever. This is the price of risk, and this is the how much of risk. And anything you earn outside of that is your alpha, and you want that to be positive so you can become rich and make a lot of money. So if your average mutual fund investor, by definition, their average beta is 1, then the RFs cancel out, and the expected return for that mutual fund manager is just the expected return on the market plus their alpha. And so they're trying to show that they have positive alpha by outperforming the market. This model of risk and return was created in the early 60s, and the extensions are straightforward refinements of this approach. So it's been around for a couple generations. The problem, as Eugene Fama and Kenneth French documented in 1992, is that when you measure beta correctly and adjust for size, you find no relationship between beta and return. And this beta is the measure of risk in the CAPM. And this generalizes to all the other models. So when you have return here on the vertical axis and the betas here, you get this blob. And theoretically, you should get this straight line. So you should see dots that form an ellipsoid. But you don't. And this has been documented again and again. Beta does not work, and the extensions also do not work. So that's a puzzle. My theory is that with relative utility, you get no general risk premium. So this is the equilibrium result. That is, instead of maximizing income, where each dollar is worth less to us, we maximize our status. In that case, all risk is like idiosyncratic risk, unnecessary and so unpriced. Think of the following, that in the standard theory, to take no risk is to keep all of your money in cash. In a relative environment, the riskless thing to do is to have all of your money in the market. That way, if the market goes up, you stay in the same place. If the market goes down, you're still in the same place. So deviating from the market is unnecessary. It's not like people have to take risk in equilibrium in a relative status world, and therefore it becomes like idiosyncratic risk, unnecessary and unpriced. I admit that the risk premium does exist, but it's really a cash price premium, and it's really outside of that other theory. It's really independent. But you get about 100 basis points from going from AAA to BBB in bonds, or from 3 months to 1 year in the T-bill. But I'd say that's more of a price premium you get for going to cash. Basically you can use these things in repos as collateral, and so there's a 100 basis point cash convenience for these assets, as opposed to a risk premium, because it does not generalize in any straightforward way. There is an equity risk premium for efficient investors, so if you invest in futures or equity indices, or that is a way to make a couple 100 basis points above the risk-free rate. But For your average investor, it's a mirage. The average investor does not take advantage of this because of taxes, they overtrade, transaction costs, the bad timing in the market. If you add all those things up, your average investor actually makes a lower return than cash. And I document this in the book and in the video. And my theory also addresses why people pay for hope. Highly risky assets generally have lower than average returns. So the lottery, the lottery is famous because for every dollar you spend on the lottery, the expected return is something ridiculous like negative 80%. But people buy it because you become insanely wealthy overnight. Now, in a similar way, though not as extreme, highly volatile stocks and junk bonds can make you rich. Not only directly, but indirectly, because you can signal you're a good asset advisor. And so people gravitate towards these highly risky assets. And the implication of that is it generates a lower than average return for these assets. Now, why would you do this? Why would people pay to take risk? Well, part of it is overpaying for hope. And I think they're drawing a bad inference from the general rule that you have to pay to take risk to find what you're good at. And in that sense, taking risk generates a higher return. If you want to find your optimal niche in life, you have to try several things, and you're going to fail. And it's only until you try several things that you find what you're best at. But then you stick with it and you play it forever, and you're basically finding your competitive advantage. So you might try sports as a kid, you might then try music and math and debate club, but then you find something you're relatively good at and you stick with it. But you had to fail first. So in that sense, the intuition, you have to take risks to get return, is correct. But it's a bad passive rule for investing. It's not like if you take risk in assets, highly risky assets, you're finding something consistent with your comparative advantage. For most investors, they're just buying lottery tickets with the same result. There are several implications to these ideas, and I'll mention a couple. First, you want to avoid high-risk assets if you don't have a plausible comparative advantage. Things like call options, B-rated bonds, volatile stocks. These all are objectively risky. They have high volatility, high covariance with the business cycle, and they all have lower than average returns. So it's okay to take risk in a process of self-discovery to find your comparative advantage, your best fit, but not simply in buying risky assets. Because CAPM does not work, beta arbitrage and minimum variance portfolios allow you to increase your Sharpe ratio not only by reducing the volatility you experience, but also by increasing the returns, because we find they have slightly higher returns and a much lower volatility. So if you can trade your envy for greed, these are win-win in a Sharpe ratio space. Also, forget about risk-adjusting returns. Just like derivatives, ignore that, focus on the payoffs. Now, there are several videos in this series. This is the intro, the mini intro that I'm posting on YouTube, so it's less than 10 minutes, but I have a longer intro that's available on the website that goes over in depth what these ideas are and where I'm coming from. I critique conventional asset pricing theory, so I present an MBA course in about 45 minutes, going over the CAPM and arbitrage pricing theory in some detail. Then I go over the history of the empirical tests, looking at the academic literature, how in early 1970s we thought these theories worked and we no longer do. Then I go over the vast scope of empirical failures. This is really a novel part of this book, and these videos is showing how this theory works when applied to corporate bonds, currencies, futures, call options, things of that nature, and just shows how barren this theory is. Then I go over where the standard theory seems to work, because in the short end of the yield curve or the AAA to BBB spread, we do see a positive risk-reward trade-off. Also the equity risk premium, which is often seen to be too large, and I discuss those and what they mean. Then I go over the flawed core. It's not like people made a math error in their reasoning from assumptions to implications. The assumptions of utility theory that investors agree are at the core of why this theory fails. Then I present my new theory, which is basically the implications of having a relative status utility function as opposed to one focused solely on one's own wealth, and also how the search for alpha generates a negative risk-reward premium at the high end of the risk spectrum. I present examples of alpha, convertible bonds, pairs trading in the 90s, things that have worked in the past. They're detailed, parochial, and they're also short-lived, but this is an example of what alpha looks like in practice. Then I go over tactical recommendations, going over the performance of things like beta arbitrage and minimum variance portfolios and how those would perform. But I hope you take a look at the videos. You can see the links in the sidebar. Go to defprob.com, see those longer videos, or you can buy the book at Amazon.